2001, a company called Enron reported a profit of over $900 million. A few months later, it collapsed completely. No cash left, no jobs left, no company left. Here's the part that should bother you. Enron wasn't lying about being profitable, not at first. On paper, it was one of the most successful companies in America. Investors loved it, analysts praised it. So how does a company that's making money die from having none? The answer isn't fraud. Fraud came later, almost as a cover-up for something simpler. The real answer is something almost nobody outside of finance ever gets taught. And once you see it, you'll notice it everywhere. From massive corporations to the paycheck sitting in your own bank account right now. There's a secret sitting underneath every business on earth. It's the difference between looking rich and being rich. And the people who understand that difference end up quietly controlling the people who don't. Chapter 1. The Lie Called Profit. Profit is not money. That sentence sounds wrong, but it's true. Profit is an opinion. It's a number created by accountants, built on assumptions, timing rules, and estimates about the future. Cash, on the other hand, is a fact. It either sits in your account or it doesn't. There's no interpretation involved. Here's a simple version. Imagine you run a small furniture store. You sell a sofa for $2,000. On your books, that sale counts as revenue the moment the deal closes. Congratulations, you're officially profitable. But if the customer pays you in 60 days, guess what you actually have in your bank account right now? Nothing. $0. Meanwhile, you still have to pay your employees this week, your rent this month, and your supplier. In real cash, not in future promises. This is the gap almost nobody sees, and it's the same gap that quietly killed Enron. A business can be profitable on paper and completely broke in reality at the exact same moment. Both things can be true at once, and this gap is not an accident. It's not a flaw in the system. It's a system in itself, one that's very old and very deliberately used by the people who understand it. Accountants even have a name for the moment revenue gets recorded before the cash actually arrives. They call it accrual accounting, and it exists for a good reason. It lets businesses match income to the period it was earned in instead of the random day a check happens to clear. But that same useful rule creates a blind spot. It lets a company look successful on a report while quietly running out of the one thing that actually keeps the lights on. Chapter 2. Why this still matters today. You'd think in 2026, with instant payments and digital banking, this problem would have disappeared by now. It hasn't. If anything, it's gotten more powerful because it now operates at a scale most people never get to see. According to multiple U.S. banking industry surveys, roughly 60% of small business failures are linked not to a lack of profit, but directly to cash flow problems. Not bad ideas, not bad products, not even bad customers. Timing. A restaurant can be packed every night and still shut down because payroll comes due before this week's cash actually clears. A construction company can win a massive contract and still collapse because materials have to be paid for months before the client settles the final invoice. Meanwhile, some of the biggest companies on earth have figured out how to use this exact same gap, not as a threat to survive, but as a weapon to grow. Chapter 3. How the machine actually works. Let's follow the money through a real, everyday example. Amazon. When you buy something on Amazon, your card gets charged almost instantly. Amazon has your cash within seconds of you clicking buy. But the seller who actually shipped that product, they often don't get paid by Amazon for weeks, sometimes closer to a month, depending on the payout cycle. In that gap between your payment and the seller's payment, Amazon is holding your money, not spending it yet, not owing it yet, just holding it quietly and using it in the meantime. This is called a negative cash conversion cycle, and it's one of the most powerful financial tools a company can build. In plain English, it means a company collects cash from customers before it ever has to pay its own suppliers. The company effectively gets to use other people's money for free for weeks at a time. Costco runs a version of the same play. Members pay their annual membership fee up front, in full, immediately. That money sits with Costco for an entire year before Costco has to deliver a single additional dollar of value. Multiply that across tens of millions of members worldwide, and you get a company sitting on billions of dollars it hasn't technically earned yet, but can already spend, invest, or expand with. This isn't shady, it's completely legal, and honestly, it's brilliant business design, but it only works because of one uncomfortable truth sitting underneath it. Even the card in your wallet is part of this machine. When you swipe a credit card, the merchant doesn't get your money instantly. Visa and MasterCard, along with the banks behind them, take a small window of time to settle that transaction, sometimes a day or two. Multiply that delay across billions of transactions happening every single day, worldwide, and you start to understand why controlling payment networks is one of the most quietly profitable businesses on the planet. It isn't about lending money. It's about controlling the moment money moves from one hand to another. Chapter 4. Someone always pays for the gap. If one side of a transaction gets to hold cash longer, someone else has to wait longer to get paid. The gap doesn't disappear. It just moves. Big retailers negotiate extended payment terms with their suppliers, sometimes 60 days, sometimes 90, occasionally stretching to 120 days. That means a small manufacturer might ship a product today and not see a single dollar until 4 months from now. For a massive company, that delay is a rounding error buried in a spreadsheet. For a small supplier, that same 4-month gap can be the difference between staying open and shutting the doors for good. This is the part that rarely gets said out loud. Scale isn't only about size. Scale is about who gets to control time. Big companies can afford to wait to get paid, or more accurately, they can afford to make everyone else wait instead, while they use that float to fund growth. Governments play a version of this same game, just on a much bigger stage. When a government spends more than it collects in taxes, it doesn't create the extra cash out of nowhere. It borrows against the future, issuing debt that promises investors repayment later, with interest. The government gets to spend today. Someone eventually pays for that gap tomorrow, often through future taxes or inflation. Even the Federal Reserve acts in a strange way, like a referee for cash flow across the entire economy. When it raises interest rates, borrowing becomes more expensive almost overnight. Suddenly, companies that were quietly relying on delayed payments and cheap credit to stay afloat start feeling real pressure. A cash flow gap that once felt completely harmless can turn dangerous within a single earnings quarter. Chapter 5. Myth versus reality and the question that remains. The myth is simple, and it's what most of us grew up believing. Make money and you'll be fine. The reality is more unsettling. You can make money and still run out of it. You can lose money on paper for years and still survive, as long as cash keeps moving through the door fast enough. This is exactly why so many fast-growing startups, ones with millions of users and headlines calling them the next big thing, can still collapse almost overnight. Growth costs cash before it ever produces profit. Marketing, hiring, and inventory all have to be paid for today. If the cash runs dry before the profit catches up, none of the excitement, the headlines, or the user growth matters at all. Zoom out far enough, and you start to see the entire economy is built on this exact same tension. Individuals waiting on paychecks, small businesses waiting on unpaid invoices, corporations timing supplier payments down to the exact day, governments borrowing against decades of future tax revenue they haven't collected yet. All of it is the same game, just played at wildly different volumes. The people and institutions who understand cash flow don't just survive longer than everyone else. They quietly gain power over everyone still operating on the old myth, the myth that profit alone equals safety. So here's the question worth sitting with. If the wealthiest companies and governments in the world are constantly playing games with timing, not with actual value, then how much of what we call the economy is really about money existing at all, and how much of it is simply about who gets to control when that money moves?